Good morning. I'm Vince Lancy. This is the Gold Fix Market Rundown. Today we'll be discussing JP Morgan upgrades miners and Goldman sees more copper upside. Let's start with the markets. The 10-year yields are 435, up 3. The dollar is 104.34, up 12. The S&P 500 is 57.75, down 6. The VIX is 17.39, up 25. Gold is 30.25, up 6. Silver is 33.71, unchanged, up 2 cents. Copper is 5.20, up 3 cents, but it's been the rock star. It was up a percentage point about a half hour ago. WTI 69.85, up 37. Natural gas 3.81, down 6. Bitcoin 87 spot 700, 327. Palladium 959, platinum 976, up 2, down less than a buck. You can see the grains there. Press for time, we got to get going here. There we go. JP Morgan upgrades the mining sector on China stimulus and copper upside. That's a paraphrase of the headline out of investing.com. We're going to discuss that in context of more important reports. There's the front page, lower left-hand side. The rally gold advocates did not predict again. That's an editorial in response to the World Gold Council's recent report, which we also covered. All right. Featured today, World Gold Council. Gold reached $3,000 a record time. Now what? Founders, the drums pound even louder for Alpha. That's about miners. RBC, that's about miners. The commodities feed, that's about Venezuelan oil and copper. And SG technical analysis, that's Forex and bonds. No commodities in that one. All right. Let's start. Let's read a paragraph of this to you. We're on a deadline here today. We want to get going. JP Morgan has shifted its stance on the mining and metals sector, upgrading it from underweight to overweight in a note published Monday. The move reflects a change in outlook, with the bank pointing to improving fundamentals and a potential rebound in commodity prices, especially copper. The strategists describe what they see as a V-shaped recovery emerging in late Q1 2025. A big part of that rebound is being driven by increased economic stimulus from China, alongside tightening supply-demand dynamics in industrial metals. That's not the reason this report came out. We haven't seen it yet. They do say some truth here. It's a significant shift after years of poor performance. Mining stocks have underperformed broader markets for some time, trailing the MSCI Europe index by roughly 50% in dollar terms since January of 23. They've also lagged behind industrial metal prices by about 20% since early 24, according to the bank's strategist. That gap, they argue, isn't normal, and it's catching investor attention. I want to stop right there. You can read the rest of that, and I want to go to this. I'm going to just fast forward. You can read the rest of that right up there, and I want to go to this. The context is in that sentence. That sentence says it's catching investors' attention. That's because gold's at 3,000, silver's at 34, Trump is tariffing everything, and AI stocks are not doing as well. So investors are calling the banks saying, we want something else. Bonds, no. We like gold and we like silver. And so the banks, some are saying put a little money in ETFs. Some are saying, you know what? We can't ignore miners anymore. They want to keep the money in-house, and so money is going to start going into miners. And it has gone into miners. You've seen it. When AI sells off, miners are not as weak. When the stock market rallies, miners are keeping up for a change. Okay, so there is a change in the mindset of the market. Miners are on the radar of the people, and the people are filtering up to the banks. Case in point, March 15th, Bank of America asks, who's exposed most to gold price changes? Small universe, great report. Okay. March 21st, we have that. March 21st, Trump executive order invokes wartime powers to expand critical mineral output. The increase in demand is calling for an increase in supply. All right. We need to be a domestic producer. March 24th, RBC's the gold standard. Miners with exposure to spot gold. Notice the theme with BOA and RBC is not who's the best run company, although that matters. It's who has the proper exposure to gold. So they're probably steering people away from streamers and towards big producers with operating leverage or mid-sized producers that are under hedged. Okay, the client base is probably beating the drums for alpha, and the banks are responding to that. A little bit of a comment about the BOA one. Listeners for the last, I don't know, 6 months have noted Michael Hartnett's weekly report. He has been talking about BIG, bonds, international stocks, and gold. And every time he talks about international stocks, I will say to you as a gold person, if you're talking about international stocks, you're selling US stocks and rolling them into international. If you're talking about international stocks, you're talking about a weaker dollar. If you're talking about international stocks and therefore emerging markets, you're talking about gold. Gold is an emerging market in the big picture when you look at it as competing for flows. And so therefore, if Hartnett is talking about all these things, someone in the bank is going to recommend miners. And lo and behold, March 15th, Bank of America says, these are the miners we suggest you buy for exposure to gold. Or if you don't want a lot of exposure to gold, buy this miner. Okay, that's March 15th. March 24th, RBC, always a big mining bank in general, but they had been actually kind of negative on miners, or let's just say depressed on miners, as recently as a month ago, showing the lack of flows. They come out with an entirely different type of report than BOA. BOA's report is educational, it's readable, and it's got some very good graphics. RBC has a bigger universe of miners they cover, and they just go, boom, here they are. Here's all the miners. Tape them to your wall and start looking at them. That's basically it. So both of these reports together, if you're looking at miners or your clients are looking at miners, probably are must-have in getting you started down the path to stock selection. Which brings us to the commodity. March, I think it was 24th. I'm not sure, but Goldman Sachs sees upside in copper, right? Now, I'm sure they're going to be talking about miners as well, but they talk about upside in copper and they give many reasons. It's a relatively short note, but there's a lot of information there. The background on the Goldman note is this. The background of the Goldman note is Goldman has been calling for 10,000 a ton in LME pricing for probably 4 months. And they were saying it would happen by, let's say, mid-year, maybe the end of the first quarter, maybe the end of the year. And it happened early. And so right now they are looking at their price target in copper. Expect them to upgrade that price target, which will cause more flows to go in. But they go through it and they lay out their base case. This is why we were bullish to begin with. And then they say the tariffs are more bullish than we thought for copper. And the evidence is COMEX copper is going up because everybody's pulling metal in anticipation of tariffs. But overseas, copper is also going up. It's starting to keep pace in these recent rallies. Now, that would be indicative of a shortage of supply. So, for example, if the tariffs go up, if there was extra supply out there, then the rest of the world will just sell it to us and say, you're an idiot, buy it, and the price will remain the same outside the rest of the world. But the reality is it's not. It's starting to track it. Now, if that's the case in copper, that's the case in silver, and silver is much worse, but you're not seeing that manifest in prices the way you are in copper. So we believe that they're probably going to be upgrading their price target soon. We have the full note. It's at the bottom. Enjoy it, but the whole complex here is about miners now, right? There's all kinds of technical levels. Jordan and I talk about that. I talk about it with other people. The miners are potentially in play now. And as a disclosure, yesterday I added GDX and sold the SPY against it. So I could change my position tomorrow. But if people like me are the way I think are looking at this, then start thinking all the macro discretionary boys who bought gold are going like, well, what else can we buy that's gold based? Oh, look at those miners. That's pretty cool. And I think that's what's happening right now. All right. Again, that's at the bottom. There's the chart just depicting that. Market recap, stocks ended slightly higher as investors assessed latest economic data and U.S. trade policies. Benchmark yields slipped. The dollar inched lower, and gold was a little bit bid yesterday. Oil prices were edged a little bit higher on all kinds of concerns. Okay, on deck today is durable goods. Excuse me. Chart. I said that this is a measured move that should end at 35. And when it pulled back to here, I was very nervous. It didn't settle under here, and now here we are rejecting it soundly. That's great. Okay, this started, we'll call that low, February 28th. Let's look at the low of gold February 28th. What has gold done? Is this February 28th? Yeah, it is. Gold has outperformed silver since February 28th. Copper has outperformed everything since February 28th. Okay? So of these three metals, silver has outperformed gold and copper year to date, I believe. I know it's outperformed gold. And copper, since February 28th, copper's outperformed everything. Then silver and gold, roughly neck and neck. The reason I'm bringing this up is because this last leg of the rally, this last we're seeing here, that's tariff based. So silver demand isn't tariff based, although it is. Silver demand is the fact that the LBMA does not have unencumbered metal that's available, and they're struggling to source it now. So when you look at this behavior in context of the reports that are out, and you look at this behavior in context of PSLV getting shorted and metal being pulled out, SLV getting added, metal added to it, COMEX metal being added, LBMA metal being pulled out. This is not tariffs. Tariffs are a cover for something else. Just like COVID was probably a cover for something else, but we don't want to get too paranoid on that. Anyway, if copper pulls back, watch what happens with silver. If silver pulls back more, then you know that there was a lot of fluff in silver. If silver pulls back less, then you know that the silver problem ain't going away. The copper just got a little bit overbought. I'm Vince. Have a great day.